Hey guys, it's Will. In this one, we're going to be using this cool setup here with the iPad to do some clear explanations on some different investing philosophies. And I'm going to walk through the top three things I would do with my money if I was just trying to break above, let's say, $100,000 or maybe a million, that kind of $0 to $1 million in your net worth. This could be ranging from your portfolio to how you're managing your money budget wise or how you're earning money. And let's jump into it. So, this should be super exciting. The first key here is to realize, I was just talking with an investor recently, and they've had a lot of success this year with the AI market. And then, of course, there's a lot of talk around a bubble, and you have a lot of gains happening where it's similar to the tech surges right before 2020 crash in COVID, or similar to the big surge in the dot-com bubble that was in the early 2000s, and that all those companies that basically everybody was hyping up ended up not being worth anything. That is a conversation that we have a lot. I was just talking with this investor, and he said, what's the allocation strategy for investing across the domains that are going to grow the most? And then what's the way that I can manage my risk in a way that allows me to still gain during an AI boom? Let's say that there is spending increasing, which there is infrastructure. There are more monetization models being applied to AI. Some people say ChatGPT is not making that much money, but billions of people are using it, and that also allows them for it gives them the ability to do monetization in the form of ads or things like that. And so there's a lot of growth opportunities in the AI market. And personally, I'm bullish, and I don't think we're going to see a pop in this bubble because of the growth we've seen. But still there are big pullbacks. You see them all the time. You have big surges for a couple weeks, and then you get that 10% pullback or that 15% sell down in the stock market, or in it could be private, but most likely it's in the stock market, the public markets, where these AI companies pull back. And so, how we structure this, I'm going to kind of walk you through. This is really cool looking, so I can kind of like click here. I can select the allocation. So here's kind of how I allocate personally. So a lot of times what I'll do is I'll go ahead and start off with the top AI companies. So this is this is going to be your drivers, your growth engines. This is going to be the growth engine stocks, okay? And these are normally like your, Nvidia. This could be there's like a weird correction here thing here. So Nvidia, this could be, for example, what else do you got that's really big? Oh, AMD stock. All right. We got, let's say this could be your Google stock, okay? This could be what else? You got Tesla stocks. Okay, so these are your Microsofts, all right? And these are the companies that, are going to continue to grow as they have. You could also add in some of the top infrastructure plays, like you could do like Taiwan Semiconductor, or Broadcom, and add in some of those. And then you maybe even add your Palantirs. You might add in some of the other growth engine companies that continue to grow basically no matter what, right? They continue to run because of the innovation in the tech market. They're the engine. So whoa, that looks pretty cool. Interesting kind of setup here. All right. So that's the growth engine, and how I structure my growth engine is with about 35% of my portfolio, okay? So just about 35% here. goes to, let me fix that, 35% is kind of the growth engine, okay? Now, then you got what happens when, you have the pullbacks, big pullbacks. You don't want, like, there are other markets you want to look at. Like, for example, like, people think that I invest all my net worth into quantum stocks because quantum has gone up like crazy. But frankly, I'm not big on the quantum as far as allocation. I'm very bullish on the long term, and we've been covering them since they were all basically $1 a share last year. But we ultimately have been looking for growth in the area of the 5 to 10 year horizon. So we do have long-term positions, and trust me, 5-10x in a year is amazing, but I also am okay with the pullbacks and things like that. And so, because what you might want to consider is this is kind of like 5 to 10%, and this could be, actually that might change, but this is going to be your high growth tech. Okay. Now it's easy to be in the high growth tech market and go 80% of your portfolio, 90% of your portfolio. I've seen this before. But the problem is you end up over allocated, overexposed. And what happens is shortly after the pullback, you're stressing out. You're saying, do I want to hold this company? Do I want to be in this position where I'm not really sure? And the volatility is very, very high, and you get too worked up. So high growth tech, right, is going to be your companies like, this could be, this is working, there we go. RGTI is one. This could be QBTS, this could be your BBAI, so kind of defense tech, these smaller companies. This could be your IonQ, so quantum. This could be your, let's say, APLD, right? So your data center stocks, and that could be a lot of different data center stocks. Your BITFs, your NBIS, which is, these are all, data center companies. You could probably, outside of the data center market, which you could include some more there, but you'd include some of the space tech. Space tech has a lot of volatility. So you're talking about, BKSY is going to be on the list. You might have RDW, you might have BKSY, and actually I'm very confident long term on this one. I'm going to add it to more of like a growth engine, which is Rocket Lab. But again, like, you have these companies, all right, and you're in space tech, you're in the higher growth sectors. This could be like your Sound Hound, or maybe SoFi. SoFi is still pretty small. Your smaller data center companies, right, that you're watching. And so this, I don't want to over allocate in this area of high growth tech. I wonder why it's giving me that weird blue line, but we'll just ignore it for now. I don't know if I can change that, but that's fine. And so I only allocate into these types of stocks really about 15%. Only about 15% do I allocate into these types of stocks. And when it comes to the reason why is because, again, you're now at about 50% of your portfolio into general tech, high growth tech, nevertheless. And so if you have a pullback of 20%, that's going to massively impact your portfolio. Maybe you're okay with that. But again, for most people, if you aren't looking to be on an emotional roller coaster, it would make sense to allocate also into some of these markets. And now this is where I kind of come in. So growth engines, 35, 40%, you're up to 50% at this point. And then I usually am throwing in about 15%. This could be about 10 to 15% of my companies are going to be in, for example, utilities. These are your PG&Es, your let's say food, agriculture, could be like soybean, could be oil and gas, could be energy, although that's going to be highly correlated over to the tech market. Could be potentially like minerals or industries that are going to be much more different in their movement than the type of tech market that you normally see. Now, this is going to be about 10-15%. And the reason I go with these markets is because ultimately you're going to smooth out some of your portfolio. Okay. You're going to smooth it out. Cool. So then you got about 60%. What about the rest of the 40%? This is where I'll usually invest into, and this could also include another probably 10 to 15% into, these are your more conservative, maybe gold. This could be your, yeah, I mean, you could do silver. You definitely have a large demand right now for copper. A lot of news around copper being more valuable than pennies. You're going to look at maybe related to, yeah, maybe related to like uranium or, you know, the type of like minerals that are hard. So I usually do about 10% there. And then, so we're up to about 70%. What about the rest of the 30%? So the rest of the 30%, a lot of times I'm invested into, and this is what I do. Most people buy the index fund, and that really smooths things out. You could totally do that. And I recommend that for most people, index funds. So that would be index funds. These are your, you know, your Vanguard, VOO, your VOO, your S&P 500s, right? All those kind of like index funds that are going to be low risk. And this is where I allocate. This is how I allocate the rest. So 30%, that's basically everything in this high growth tech sector. Each one of these kind of has a strategy. And I also invest heavily in crypto, but that's kind of for another conversation. But in this area, you know, you can see that the 15% growth tech over here, a lot of these companies here, I don't do the index funds as much. I personally allocate heavier into the growth engines and the high growth tech. And the reason why is because if you're going to invest in index funds, it's safe and it will smooth out your portfolio. In my eyes, I've had a really good ability to pick stocks in my experience. And so it makes sense for me to focus on individual stocks. Now, if you're like, okay, I'm still learning, I don't really know, I'm kind of learning, it's like not 100%, then index funds basically smooth the ride in your portfolio, smooth it out. And so that's what I do. And now how I do it is this 30%, is a lot of times I'll allocate that into these kind of shorter term trades here, where what I'll do is I'll basically allocate from those into trade / dip buy or um, or could be potentially shorting stocks. So I'll allocate usually in this area. Sometimes there's a lot of great companies that are being talked about, and you see people talking about these companies, but in the long term they look good, but in the short term they're way overextended. Quantum is a good example. And so in that case, I actually would short them to kind of hold out and make sure that my long-term positions, I don't lose some of those excessive gains that you get in the short term. Because you don't know, sometimes you get into a stock you plan to hold for 5 years and it hits your 5 year price target in 1 month. And it's like, that's great, but now you don't want to lose those gains. So if you know and you can tell and it's pretty clear it's way overbought or something, it can make a lot of sense to, if you don't want any gains or losses but still hold on to the stock's position and continue to build it, to just short it with another position and just not have it go up or down if it goes down or up, basically. So I'll short a stock so that I'm betting it goes down. I make money when it goes down. But then as my position that I was up on, that I was bullish on going for the long term, that one goes down in value. That's okay because I'm making money when it goes down from my short that I open up. And so that's a more advanced strategy, but I oftentimes do that. And then the other thing that I'll do is I'll notice, the other time I'll short is I'll notice everybody's talking about quality stocks. Like a good example would be like everybody was talking about, AMD and uh, let's say like what's another AI company? Palantir, and you could say Big Bear AI. Okay, everybody's talking about them. It's really cool. Everybody's talking about them. But then somebody else brings up a stock like this stock, RZLV, for example. And it's like it's in the conversation, everybody's kind of like talking about it and they're like mixing it in. But then you go do some research and you're like, whoa, whoa, whoa. This stock right here seems like it is way overvalued and hasn't made any money. And I would expect it to go down this, RZLV here. And so in that case, if I'm noticing that, then I will also say, well, this company's way overvalued. They're trading way above where they should be. You could see it in different industries. Like you look at robotics, you could see some ones that are signing really good contracts. And then you look at one like, for example, Rich Tech Robotics that was way overextended. You look at iRobot, like they haven't done anything since the Roomba and they're pumping because of the AI robotics. They're going to sell off when they've gone up. So it's like, there's instances where you see companies like, oh, this company's riding the hype of the market, but man, this company isn't doing jack. In fact, they might even have, in this case with RCLV or like iRobot, more liabilities than assets. And if they have more liabilities, meaning they owe more debt than they have in assets, then it would make sense that they would sell down. So in that case, I would open up, a short here. I would open up a short. Okay. And I would bet it would go down. And when it goes down, I make money. So that's one way I make money in this kind of like 30% or more aggressive. I don't do index funds. I've had experience making more money without index funds, but I encourage everybody to do them if they aren't getting well versed enough on the stocks and they don't have the time, although AI is changing that. You have a lot more time now to be able to get good analysis on companies. And so the trading side, a lot of the trading side will happen when a company sells down way past what they're worth, and I might go buy the 2x. Good example is AMD. AMD stock was just selling down, selling down, selling down. Whoa, I don't know what I just did there. Can I fix it? There we go. And they were selling down, and they sold down to like $75. And I was saying this company's worth way more. I think that they're worth, I think that they are worth like $200 a share, right? And so what did I do? I dip buy, and when I dip buy, I actually end up buying, for example, like AMDL, which is the 2X. Okay, and then when it goes up, because it's just way overextended, they got data center deals, they're working with Starlink, they're a competitor with Nvidia or what have you, they're just way oversold. And they have so much value, they're doubling their earnings, they're increasing their revenue, their assets are going up. Everybody's saying that they're way oversold, but also some people are saying this company is beat down. People were calling it the advanced money destroyer. When the talk gets so negative and so down that everybody's betting against it, it's completely beat down. That's when I'm like, all right, let's go in, let's get a 2X. And it would go, for example, like AMDL, if it goes up 100%, in this case, AMD recovered to, 180 and then $200 a share and much more. If it goes up 100% on AMDL, that's going to be about 200% minus a little bit of a management fee because it's a 2X fund. So they have I don't know what it is, 3-5% a year or something. But when I trade big opportunities, and I do it on dip buy opportunities, and I do it when it feels like everybody's counting the stock out and they're extremely scared and people are getting ready to quit in the stock market. That's when I like to trade. And so Red's your friend. So hopefully, those are kind of helpful. I wanted to give you guys the full breakdown on how I allocate and what the thought process is in those allocations. And then the other key factor when I'm looking at these markets here is I'm oftentimes looking at where things are going to be 5 years from now and trying to invest in them now. There is this law that's really amazing about the stock market. And I love the stock market for a few reasons. The first reason why I like it is because it rewards values. As much as people say that it's rigged and it's really hard and 95% of people fail or whatever it is, which I don't even know where those statistics come from nowadays. I have tons of friends that are absolutely crushing the market and have been since I was in middle school. Maybe I have outlier friends or outlier circle of influence of people that are doing it. But I think it's the easiest time ever to get alpha on stocks and no insight that the flow of information is so massive. In fact, the only thing you got to watch out for is not that you're not getting the word, it's that the word you're getting is manipulation or fake or something like that. And so when it comes down to structuring or why I love the stock market is because your values will equal your values. So, for example, if you go into the stock market in any investment, and this is correlated with life, right? But really, if you go into the stock market and you are looking to make a bunch of money and you're looking to do it, let's say, no time, let's say very fast. You're looking to make a ton of money very fast, okay? If that's your goal, then it will require very fast analysis. And if you don't have very fast analysis, then you'll end up getting burned because you'll be thinking you're going to get in, and if you're wanting to make money really fast, but you're not giving it the very fast analysis to be on top of everything, then you won't make money. And the same thing is true if you wanted to, if your values are the opposite of the end result you're going for, you will not get the end results. And that's so true because what will happen is, let's say you want to, like, the values that are very heavily rewarded would be, what does the most successful investor in the world have as one of his core values? It's called Warren Buffett. What is it? It is, for example, patience. And so there's certain values that are heavily rewarded when you have them. Patience is one. So if you have patience for the money, then the money will come to you with the time and patience that you have. And if you have very emotional, let's say that you're, and patience is what? Patience is something that slowly you demonstrate throughout time, right? So you'll be rewarded with patience throughout time. Now, what if you are going in very emotional? This goes good and bad. If you are very emotional, what do you think your portfolio is going to look like? What does it mean to be emotional? Does it mean to go up and down and up and down? Yeah, exactly. So emotions cause more volatility. So how do you make more value? How do you make more money? You can give more money, of course. How do you make outsized returns? You need an outsized input. So let's say outsized returns require the outsized inputs. If you want to receive back and get the output of something that's outsized and very good, you have to input something that is very good and outsized. And so that means that you have to match what you're going for. And this is the key in stock investing. If you want your portfolio to slowly go up, you have to adjust risk for that. People that want to make great trades let their losers ride, and their winners, they cut them short. And then they end up losing and bag holding. Why? Because they have the values of letting their losers ride and cutting their winners short. They get a little bit of money, they take it, versus adding to the winners and seeing the winners go up. And then when it goes down, they're able to manage the risk, lock in the profits. And if it goes down, they're risking less than they're going for. And so outsized returns equals outsized inputs. You've probably heard, oh, well, you could make a really great return, but the risk is pretty high. That's a pretty fancy way of saying your returns and your inputs. You want more, you got to risk more. Or you can either risk more or you can become better. Either way, you're going to have to risk. But it helps if you are, for example, you want a company that has good financials, you'll need to identify what good financials look like. If you want a portfolio that's growing, you'll want to invest in companies that are growing. And that's something that really changed the game for me. It's just realizing, like, the portfolio that you have will be a reflection of the companies you choose to invest in. There will be volatility, but here's the deal. This is a key factor. If you want to have steady returns, your actions must be steady. If you want steady returns, your actions must be steady. Very simple. So it's like, if I'm taking a super high risk, yeah, I might see something up, but what happens? I'm going to see that thing go up. I might make money, but am I going to keep it? Probably not. And so a lot of you guys are struggling with the idea of managing your risk so that you could have steady returns. And it comes down to what your goals are. And if you want to you have to create the reflection of what you're going for. Find the reflection of what you want. It's like, if I am trying to attract something into my life and I'm hanging out with somebody and I want them to like me, I'm not thinking to myself, oh my gosh, does this person like me? Does this person, oh, I hope that this person's like, and then you're talking to them, you're like, hey, do you like me? And the person, what? They don't like you because of, you're like, the person's like, oh, I really hope I don't step on your toes, right? You don't want to be that person. And so instead, what I think is, I'm not going to worry about, oh, I really hope I have a good stock. I'm going to assume good stocks. For example, I'm going to assume the other person likes me. And guess what? I'll act as if they like me. And guess what? They'll like me. It's like, I'm going to find a stock that has the returns that would be good, that company makes good returns, and I can confidently look at them and say, this company makes good returns. They're going to make my portfolio grow. It's really not as complicated as people think. It's just, you might look at a company and say, oh, I don't know, and I'm going to, I hope that it doesn't go down in this. It's like, if you're saying that, you're in the wrong investment, or you need to reevaluate the mindset around it. So hopefully those are some good tips for you guys. If you guys want to tune into our daily live investing session tomorrow morning at Market Open, it's the second link in the description below. I hope I earned your thumbs up. Do consider subscribing. Let me know what you're looking for in future videos, and I'll see you guys in the next one. Thanks so much for tuning in.